Due to the growing interest in Bitcoin, in December of last year, futures contracts on Bitcoin were introduced. These Bitcoin futures allowed investors to speculate on where the underlying price of Bitcoin would be at a later date and time in an attempt to profit off of the movement or to hedge against risk. CBOE was the first institution to implement these future contracts on December 10th, 2017, and then this launch was followed closely by CME Group a week later. So today, we have representation from both institutions and also from a law firm specializing in the derivatives marketplace. And we're here to talk to you about cryptocurrency futures and derivatives. So let's begin by introducing the panel. Julie Winkler serves as the Chief Commercial Officer of CME Group. She leads the company's sales, product marketing, research, and product development, data analytics, and digitalization functions, as well as the Innovation Lab. Previously, she served as Senior Managing Director, Research, Product Development, and Index Services of CME Group since 2014, and as Managing Director of Research and Product Development since 2007. Next, we have Charlie Mills from Steptoe. Charlie began his legal career as a regulatory attorney and litigator with the CFTC. Today and throughout his many years of service in the private practice, representing clients in CFTC regulatory matters and enforcement investigations has been a prominent area of his practice. Charlie's clients include a diverse mix of intermediaries, traders, and end users in the derivatives and commodities markets. In the blockchain and digital currency space, he counsels clients on compliance with CFTC regulations in initial coin offerings, trading digital tokens and coins, and the use of blockchain. And we also have Matt McFarland from CBOE. Matt heads up CBOE's futures business, primarily responsible for developing and executing strategic initiatives to increase volume in both existing and new products. Prior to managing the exchange's futures business, Matt worked within CBOE's Global Client Services Group in London, where he led the European business development efforts for derivative products. So as you can see, we have quite a distinguished panel here today to talk to you about these products. Let's kick this off with Matt. Matt, you have the title of the first exchange to list a cryptocurrency product. Tell us the story of how you decided to list a BTC futures product.
Sure. So when CBOE started looking at the crypto space, as Jennifer mentioned, we launched the product on December 10th, but there was a lot of groundwork that happened before that launch on December 10th. And as we were talking to potential customers, what we found was that customers wanted exposure to Bitcoin, but they didn't necessarily want to own Bitcoin. And a futures product allows you to do that. It allows you to have exposure to the asset class without actually owning the asset class itself. We also found that customers were expressing a desire to be able to short Bitcoin or express a short position in a more efficient manner. So when you short in the futures market, you don't actually have to borrow like you have to in the spot market. So it's a much easier way to express a short position in the futures market. And we also found, and probably most importantly, is that customers wanted to be able to get exposure to Bitcoin in a regulated framework. And the framework provided by the CFTC was certainly something that customers had a desire for. So those are kind of like the three things that were really driving customer demand for a Bitcoin futures product.
And you recently had the first expiration just this month. How did that go?
Yeah, the April futures contract expired last Wednesday. It was our fourth expiration.
Sorry about that, the fourth?
Yes, we've had four expirations, January, February, March, and April. And these expirations are very, very important because it's a cash-settled product. And a cash-settled product means that when the futures contract expires, you don't actually get the physical commodity or the physical Bitcoin itself, you actually settle to cash. And it's important that we have strong settlements because it indicates to the marketplace that the infrastructure and the integrity of our marketplace is running as we want it to. And as we have successful settlements, it instills confidence within investors, and then you could start to see institutional assets begin to flow into the marketplace. Now, the way that we describe a successful settlement would be how the settlement price, we want the settlement price to be a price that doesn't deviate far from the broader Bitcoin market, and that indeed has been the case in all 4 of the settlements so far.
That's great. So Julie, how did CME come up with their product? Can you tell us a little bit of the story? I'm curious to hear, we've heard CBOE's experience in their story. I'd love to hear CME's.
Sure. Well, certainly similar to the CBOEs, this was definitely a customer-driven initiative. Our story with Bitcoin started probably about 2.5 years ago, and as we look at any nascent market, we really need it to kind of see whether it's got, adequate size, whether there's, price movement, what are the key players in the market. And as we studied this, what we really started to put together first was the reference rate, which is what we use for cash settlement in our product. And so a year ago in last November, we introduced the reference rate, which is based on 4 different spot exchange rates, all contributing to that index price. And that was kind of our first foray into the space of saying, hey, we don't have a futures product, but we have a reference rate and a real-time index that we began publishing. And once we kind of introduced that, I'd say more and more questions came in from our clients. And that was really when a lot of the in-depth discussion started of saying, we really would like a futures contract for many of the reasons that Matt pointed out. We are searching for a risk transfer mechanism. We're looking for something where we can have some price discovery, but doing it with the trading platform and the risk management that we're used to getting from CME Group. And we held probably over 200 different client conversations, very detailed conversations with our regulators as well. And that's really how we came up with the product design that we introduced. And I'd say a lot of time and effort went into saying, the market seems ripe for a contract. It had grown enough in size, it had grown enough in notional activity to support it. And it seemed like the market was ready, and I think the results really from the last 4.5 months have proven that there is a need for this futures contract to be out there. It's great to have some competition out there with CBOE's contract as well. The contracts kind of serve different needs, and both of the contracts are seeing increasing average daily volume and open interest, which again, from my perspective, is really a sign of great things to come.
Yeah, so this is interesting because I liked how you touched upon the reference rate, and I think that, especially for many of the folks in the room, understanding how the futures product ties back to the actual underlying instrument is really important. So talking through how your product works, incredibly helpful. Matt, similarly, could you talk a little bit about how Cboe's product works with the instrument that you use to derive the rate?
Sure. We partnered with Gemini, the Gemini Exchange, with our product. We liked Gemini mainly because they embrace regulation like us, so they're creating an environment where investors can access this asset class in a very safe manner. So we settle to a Gemini auction that takes place every single day, but we only use it for settlement purposes 1 time per month when our contract expires. But some of the when this auction takes place every single day and it settles to our product, it's been some of the biggest trades in the Bitcoin market have taken place during this auction. And the auction itself is actually bracketed by what's called the WBBI, which is the Winklevoss Blended Bitcoin Index. So Gemini is led by Tyler and Cameron Winklevoss, and so this index it consists of 4 spot exchanges: Gemini, ItBit, Bitstamp, and GDAX. And in order to be included in that group, the regulatory requirements are quite high. So we want spot exchanges that are employing strict know your customer rules. They have enough volume there to support and be meaningful inputs into the index. So those are the types of the things we're looking for a constituent.
It seems really clear that there was a significant amount of diligence done in the lead up to this product, these products. So it's interesting to me because I know initially there were some criticisms along with a significant amount of market excitement for the product, but there were some criticisms about a perception of a rush to market, which it seems like without me even asking you guys this question, you've already very clearly articulated, a long process of diligence and research and preparation for the launch. So negating that first criticism, out of the starting gate, one of the other criticisms that we heard around the market was not having separate guarantee funds between cryptocurrency derivative products and some of the core futures products at your exchanges. And I think that a letter that garnered a bit of attention was the FIA's letter to CFTC Chairman Giancarlo asking for a guarantee fund segregation to isolate product risk. He said, "We remain apprehensive with the lack of transparency and regulation of the underlying reference products on which these future contracts are based, and whether exchanges have the proper oversight to ensure the reference products are not susceptible to manipulation, fraud, and operational risk." Now, you have already explained the diligence you've taken with the exchanges that you use to manage the conversations you've had with regulators. This nonetheless seems to offer questions of, should a major market event in the spot market happen, will that impact the derivatives market that you now have products in? So with that being said, Charlie, what are your thoughts on the validity of that concern?
Well, I think the concern was expressed by the Futures Industry Association, which is a trade association of futures commission merchants, which is the statutory name for a regulated futures broker. And I think their concern at the heart was that this product is difficult to predict how it's going to behave in the marketplace. Will we see some kind of a debacle and defaults? And the futures commission merchants will be their guarantors on those contracts. And if they're in the clearinghouse that's the counterparty to all of these futures trades, if there's a collapse in a contract, there's a default of some kind, their own assets are subject to risk to pay for the losses in that default. So they're very concerned always with how you're managing risk. From what I had gathered, there was discussions with futures commission merchants, so it surprised me. I wasn't involved in that, but I was surprised that FIA took that public view, because I thought all of that would have been ironed out ahead of time. What they wanted, it seemed, or at least they wanted more focus on it, is whether instead of having the risk on these contracts subject to the entire guarantee fund of the clearinghouse, to set up a separate and segregated clearing fund just for these products. So if they collapsed, it wouldn't tip over and go into the broader clearing assets of these firms in the clearinghouse. As time has gone on, it seems that the proof is in the pudding. There hasn't been any collapse, there haven't been debacles. It seems like it's of course still very early, but certainly the early signs are that those concerns have been addressed by the exchanges and how they're handling the contracts, and they're moderating the risk by having higher leverage margin requirements than you might see on a lot of other contracts. So I think that issue has subsided. The chairman of the CFTC, Chris Giancarlo, was very clear that the agency was not going to step in and tell the exchanges not to list these contracts because under the rules that are in place, the exchanges have the ability to self-certify these contracts, and the CFTC can't step in the way of that. And he didn't see a need to do it, although he was very interested in having broad public discussion and analysis of these contracts as time went on. I think one of the main concerns is, and I think it will continue, at least as a concern. It may never express itself as a market risk, but it's the reference price with the cash exchanges that is the central concern because those are unregulated markets. The CFTC has said specifically they don't have any power to regulate those markets. They can't write rules to say, this is how you do it, these are the reports that you have to make, and other kinds of regulations that you have for futures markets and for securities markets. And so how do you know that those reference prices are not being manipulated? And if they are manipulated, that's going to flow over potentially into the futures contract. And so there's a lot of interest and pressure, in a sense, on the exchanges, on the CBOE and the CME, to pay attention to what's happening in those reference in spot markets, cash markets, to make sure that you don't have odd activity and disruptive activity going on that would call into question whether you're getting a fair and honest market price. And that's something that I think will remain a concern because the SEC certainly, if they think trading now Bitcoin is different because I think they've, at least impliedly, they've not found that that's a security. But to the extent you have other coins and tokens that are traded that are considered to be securities, the SEC could step into those cash markets and claim jurisdiction. And until those cash markets have a little clearer regulation and controls over them, in some people's minds, by the government, there's a question of whether they're trustworthy. As I say, time will tell, and so far there haven't been activities in the market that I've seen reported that would be of concern.
In regards to the CFTC not being able to regulate the spot markets, we partner with the Gemini Exchange, and CBOE Market Reg has an information sharing agreement with the Gemini Market Reg so that they have information sharing of what's going on in our respective markets. So we both have know your customer rules where our market reg folks and their market reg folks know who's participating in these auctions. So I think in that regard, we've certainly addressed that. Secondly, in terms of the FCM concerns, I think that as a new product that a lot of people didn't have familiarity with, they had this extreme volatility that really kind of made people nervous. But I think since the futures market has actually been introduced, you've actually seen volatility subside a little bit. And that could be at least partially attributed to the more efficient means in which a short position can be expressed.
Yeah, I should follow on to that and say the CFTC has said that they did look very hard at how the exchanges are gathering information from the reference for their reference prices, and they were satisfied that they had controls in there and that they were getting the proper information. So these issues are more, in some respects, concepts of what could go wrong, not what is going wrong or will go wrong. And the CFTC has endorsed, I think, the exchange's due diligence on these reference prices.
Yeah, I mean, I think from our perspective, I mean, risk management has been the top priority leading into launch and really since launch. And, I think, it can be done in numerous ways. I mean, Charlie mentioned the margins, for these products, we're collecting 43% of the contract value in initial margin. And, while it looks like it is a volatile product, and it certainly is, it's also important to point out, it's not the most volatile product that we trade. And so I think somewhat what was happening with the context is, if we remember back to 2017, there was not a lot of volatility in the marketplace. The hype was certainly around cryptocurrencies and Bitcoin, and there was some apprehension of saying, how much trading activity might we see in these new futures products, and is everybody equipped to be able to handle that? And I think, definitely the answer is yes. Besides initial margins, we have a 20% hard limit, both on the up and down side, which is a little unusual for a futures product. And we have, some speed bumps along the way as well to make sure that we have orderly trading activity. We are collecting that margin for, on behalf of the FCMs to fund the appropriate level of risk for those contracts. And we also have risk controls so that if an FCM doesn't want a particular customer to have access to that product, they can block that at the customer level. And so, we brought a lot of different things, to bear on this to make people, feel protected, and they are protected. But again, I think it's a different marketplace. People are not as familiar. And also just important to point out, the CFTC does not oversee other cash markets either. So this is not unusual or unique to Bitcoin. They don't, oversee the corn market, which we have traded, corn futures for 150 years here. So it just you have to put everything into context.
Yeah. It's really interesting. I think the idea of, trying to protect the marketplace and market participants obviously is the goal of any regulatory body. So it makes sense that they're concerned with or asking questions around all of these what could happen, what if and what if and what if. And honestly, these are good questions that they should be asking. One of my favorite what if questions is, what if the underlying product forks? What is the protocol in place to handle another Bitcoin fork? So let me start with you, Julie.
We have a policy out there today. Our actual reference rate and our index is overseen by an independent oversight committee, and that's per existing global standards and IOSCO principles that other benchmarks follow as well. And so it's really, as it currently stands, up to the oversight committee to determine how to handle that fork. We are evaluating some other alternatives, which may be, doing cash adjustments to positions and/or creating additional futures positions for clients based on a fork. This is a pretty unique thing to this product, and so that's why I think it's taking definitely some creativity from our research team and a lot of client validation to really say what is going to fit best for people's needs, as well as what can the infrastructure kind of support, because unlike other product changes, sometimes we have months of notice before things need to change. This is something that happens in a very short period of time, and there's just some more constraints that we have on back offices and FCMs and how that all needs to work. So we'll be ready for it.
Sounds good. How about you, Matt? How's CBOE looking at that possibility?
So hard forks at CBOE are, our policy is actually Gemini's policy, our partner. So Gemini, led by Tyler and Cameron Winklevoss, have demonstrated great leadership in this regard. And what the market really wants and needs in terms of hard forks is objective criteria. They want clarity. We don't want to bring any kind of subjectivity into this process. So Gemini's policy and our policy as a result is that they will follow the blockchain that has the greatest cumulative computational difficulty. We feel like this is a very clear, transparent, objective criteria, and that is our plan if and when a hard fork happens.
Okay, very good. It's good to hear that there are these plans, and it's going to be very interesting. I think, I'll just throw out my own little speculation here, maybe when instead of if, you guys are dealing with this potential eventuality. So moving on to another area of the technology in general, kind of coming out from the rabbit hole of cryptocurrencies and derivatives, obviously we're all incredibly familiar with the underlying technology that actually powers these products, distributed ledger technology. So when we think about distributed ledger technology and the fact that you guys are operating exchanges that could potentially benefit from some of these back office use cases of the technology itself, how does CBOE think about some of the utility benefits of the technology in addition to the product benefits?
Well, when I think about the blockchain technology from an exchange-traded derivative perspective, what I think about, I think the greatest opportunity is in the potential capital efficiencies that it could offer to the marketplace. So, for instance, if you were to trade a product on my exchange, the CBOE, and let's say you were to trade a VIX future, which is one of our most popular products, and you were to trade a S&P 500 future on the CME, different exchange, different clearinghouse, two separate clearinghouses require two separate margin requirements, so you're placing capital in two different places. If the distributed ledger could be used in a manner to where clearinghouses could communicate with each other, it would allow for, it would free up capital and capital could be deployed in a much more efficient manner. And that's probably something that I suspect that CME and CBOE could probably agree on, that if our customers' capital is deployed in a more efficient manner, we're probably both going to benefit from that.
Definitely. How is CME thinking about blockchain utility?
We've been looking a lot in the post-trade side of things. I think as industries evolve, and this happens in a lot of industries, you have a lot of standards and protocols and file transfers and things that don't maybe evolve as much as they should over time. And we are really very focused on saying where are there client pain points that we need to solve for, and then asking ourselves the question, is distributed ledger and blockchain a potential solution for that? And as we've done a number of use cases to date, I think there's been quite a few learnings too of just saying, it's not just about identifying the pain points and figuring out the technology aspects, but do we have the right actors and participants around the table to really make this a meaningful POC that we can actually turn into a pilot and ultimately put in production? And so what we find is like getting all of those people to the table, it's like the ultimate dinner party. It takes a really long time. And so that's where we're trying to really put some patience and really good thinking into, let's map this all out. Where do we need to start? How can this be additive? Because you do have to exist within the existing infrastructure. And so it's not like we can just pop in this new technology and it's solved for. And so I think that exerting some patience as well as making sure you've got the right people there. And again, for us, the pain point has been primarily observed in that post-trade space, and that's where we're working most feverishly.
Yeah, and it's interesting. I like that you raise the applicability with the time that it takes to actually get there. These solutions are not going to be running full speed tomorrow or even next month. No. We have to figure out how they're going to work with some of the let's just call it, moderately antiquated infrastructure that all of our various institutions are dealing with. So as we think about the way in which the underlying technology will provide these, efficiencies to the core markets, we should also think about the way that this underlying technology will change the way that the markets actually are structured. We don't know what that may look like. There are the unintended consequences that we're always trying to navigate. Charlie, I'd really like to talk through a little bit of how you could see using some of this technology for the record-keeping purposes and how that actually might affect the way that the marketplace and the clearing parties participated in it today.
Sure. all of these things are in the future. You're trying to figure out how a technology that isn't necessarily fully adequate to do the job you'd want it to do today could do something in the future. So there's a bit of speculation in it. The existing infrastructure, the legal infrastructure, also has a bearing on how blockchain technology might be used in the future. If you're trying to use blockchain within the context, from my point of view, of a central marketplace, I'm not sure it's going to work very well, because you are, especially if there's margined trades. If there's margined trades, somebody has to know where that money is, where the collateral is to cover those trades. Is that going to be on a blockchain? Is it going to be in a private wallet? If it's in a private wallet, you have issues about who's going to have access to it. And one of the leading benefits, it would seem, as it's projected of blockchain, is that you don't need, that it's inviolate, and you're protected as long as whatever in your private wallet is there and you're the only person who knows the key. Well, do you need to give that key to your broker if the broker is going to have to be responsible for handling margin requirements on your trades? That infrastructure seems to not really fit, from my point of view, with blockchain. Another facet of blockchain is how does the government interface with it? And here again, I think the chairman of the CFTC and probably others at the agency and maybe at the SEC have noted how blockchain could be a great tool to the government, because it would allow them to have greater clarity about what's going on in the market. Now when I hear that, that means the government's going to have a window and have access to what's on the blockchain. And I think some constituencies in this environment don't want the government looking into blockchain and where their assets are. And so there can be a tension there of whether whether blockchain as it's conceived, as it might be best used, will be attractive if the government's going to now use it to monitor everybody in the market. And that's kind of what the government does today with the exchanges. They have access to all the information going on the exchanges. I can't imagine the government would say, well, for a different technology, we will remain ignorant about what's going on in the market if it's going through that technology. On the cash exchanges, it's being used, and it seems like a very useful product, because you're really doing bilateral transactions of one kind or another. And that's where you can take out, in a sense, the middleman. You don't need as many intermediaries. But once you have a margin trade, you're going to have an intermediary of a clearinghouse or somebody else's escrow agent's going to be holding collateral until the trade is settled and either the margin is no longer needed or is paid over to the other side. So I think it's unclear how blockchain will ultimately come forward in this marketplace. And I think the exchanges, as you've heard, are looking at it very carefully. It seems like there's a lot of benefits there, and it's how to harness those. But to me, it remains to be seen how it'll work.
I think that's one of the most true statements that we really don't hear as frequently as we probably should. It is unclear. So with that being said, why don't we close out our time here today with a what's coming next type question. So Matt, what is next for CBOE? Any chance that we're going to get a physically settled product anytime soon?
There are some market participants that have asked for a physically settled contract. We don't have any immediate plans to do that. We're very pleased with the way that our cash settled process is working. Our agreement with Gemini does allow us to list derivative contracts on other cryptocurrencies. So the Gemini currently only trades Bitcoin and Ether, but they have publicly announced that they are going to list other cryptocurrencies on their exchange, which in turn gives us the opportunity to list other futures contracts. But we don't have any immediate plans to list a future on any other crypto at the present time. We're just focused on the Bitcoin, but certainly see ourselves growing a crypto futures platform wider than Bitcoin.
Very good. And Julie, what about for CME?
Very focused on building liquidity in the existing contracts. So we had a record volume day, over 200 million notional traded about a week ago. And what we're finding is that we're continuing to attract more and more participants to the marketplace. The bid offer is narrower than it's ever been. Good tight basis back to the cash market, and we're very focused on making sure that we build a good Bitcoin futures market before we do any additional product introductions. We are having a lot of client conversations of people saying, when's options, when is Ether, when are all these other products coming? And so we're taking all of that feedback in and really making sure that we have the most robust and risk managed product out there today, and really educating people as well as institutional investors on the value of having crypto in their portfolio, and that's what we're focused on in the short term.
Sounds great. Okay, if you guys could give this panel a warm round of applause. Matt, Charlie, Julie, thank you for joining us today.
Thank you.